In this interview, we'll go over exciting acquisitions, Heidmar's 20% managed fleet growth increase in a single PR, servicing an additional 9 vessels. In total, are now 50 vessels under commercial management, 16 under technical. All of this on top of Heidmar reporting its first ever profits since listing. We will go over why the earnings from Hormuz are just the cherry on top of a huge turnaround and growth story from here, from what some are calling the Uber of shipping, the number one tanker and ship servicing company. Going straight into the sort of geopolitical backdrop, not many people have believed those sorts of Iran peace negotiations would hold, and even if they did, that things would not normalize quickly. And you made a very strong point on that last interview. Certain countries would diversify away from Hormuz and away from the sort of 60 to 80% reliance from the Strait, especially those Asian countries. So diving straight in, what does a new normal for the Strait of Hormuz look like under sort of both scenarios? And are you long oil and rates in both cases?
Yeah, look, as I had said in the past, that I did not think that we would get to a new normal quickly.
Mm.
People are still trying to find what that actually means. And then, of course, in the last week, the ceasefire has almost been thrown out. So I don't know where that ceasefire stands today. However, clearly the importers cannot rely on the Middle East as a single source or a large source of their oil imports. So diversification is critical. I have emphasized in the past countries like Japan were importing 90% of their crude oil requirements from the Middle East. That is unsustainable. So already we are starting to see moves. So for example, Korea in their latest report has changed. They used to import about 17,000 barrels per day from Canada. Now it's gone up to 60. I mean, a significant change from them. And the same thing, as the numbers come out, we will see that this is happening across the board on all the countries. They're importing more from the Atlantic basin, so from US, from Guyana, from Brazil, and from West Africa. And as a result of that, tanker ton mile demand is going up. And this is going to be a feature of the market going forward. This
Yeah.
is not for the next month, 2 months, 3 months. This is something that we will see for the next decade, 2 decades going
Mm.
forward. And that means that tanker demand increases substantially.
Yeah.
How much that increase is going to pan out to, we will find out as things stabilize, as routes stabilize.
Mm.
Of course, we cannot eliminate Middle East oil. It's a huge portion of the global production. So that oil will still flow, but it will flow into different places. And also, we are still trying to see where things land. So, for example, Saudi Arabia, the East-West pipeline is exporting probably about 5 million barrels per day. But the rest of the oil still has to come from the Arabian Gulf. The
Mm.
UAE is exporting more from Fujairah than they ever did before. But the rest of the oil still needs to come from the Arabian Gulf. So we are still seeing VLCCs move cargoes from the Arabian Gulf out.
Mm.
However, the volumes are smaller than we expected. And I
Yeah.
think this is probably a factor is a result of the fact that the damage inflicted during the war is greater than what people have, let's say, publicized or what is known.
Mhm.
We can only speculate about that, but it's clear that the cargoes are not as much as the industry expected. But I think that all this means is that the bonanza that we expected
Mm.
will now turn out to be strong freight rates for a very long period of time because you
Yeah.
still need to rebuild the stocks. I was asked last week, what do you think is an impact of what's going on right now with the hostilities and the tit for tat? What people should be concerned about is the fact that we do not have the cushion that we had in the past. 4 months ago, we were sitting on record stocks in the US, in China, in Japan, in the OECD, and there's been a huge release of stocks, which is why oil prices have not trended over $90.
Mm.
But now that cushion is lost.
Yeah.
US stocks are at record lows going back to the 1980s, and so are stocks in the OECD. And also, the Chinese have used a lot of their stocks as well, and
Mm.
every country has. So, if we went through another 4 month period of what we have gone through the previous 4 months,
Yeah.
then we will see oil prices at 150, $200 per barrel.
Yeah.
In circumstances, of course, tanker freight rates also again inflect up to record levels. But I'm not saying or hoping that this is going to happen because
Mm.
we want the world economy to survive, to be strong, and to be resilient. But I'm saying that we need to be careful as a globe in terms of the economy that we don't have the cushions that we had 4 months ago.
Yeah. I mean, I totally agree. I mean, I was actually almost long oil before the war and even put that on my YouTube channel. And as you said before the call, before any of this, rates were at sort of 250,000 a day. So really the add-on to the rates haven't even really maybe even materialized to the point that obviously you guys benefit from as much as people think. And you make good points about, was it South Korea or Korea, 17,000 barrels to now 60,000 from Canada. The ton per mileage for all of these countries now is going to be huge going looking for other ways to diversify and get in from elsewhere. And the cushion without having the stocks is going to send oil absolutely skyrocketing if we end up in the same scenario we were a few weeks ago. Um, and also I think you made a really good point about the cargo bonanza. Did you say there was it was 10 days for some vessels have to wait to actually even get the cargo because this damage is just much more than people were anticipating?
Yes, so before the hostilities in the last 10 days, we had one vessel inside the Arabian Gulf and was looking for a cargo, and we waited over a week to find a cargo, which is unusual in any
Hmm.
circumstance. But especially in this circumstance where things have opened up, you would think that there would be a lot of cargoes for vessels which are already inside, but
Mm.
that was not the case. So we had to wait for a period of time. So, this is not the norm. And
Yeah.
so clearly, there is something more than the usual going on over there. But I think, of course, that will normalize because there's a lot of push to repair any of the damage
Mm.
that was done during the hostilities. So we hope that over the summer period and the winter months as they come up, we will see an increase in exports from the Arabian Gulf as well.
Yeah. And when whilst say there's a bit of 10 days wait, how does that affect your guys' earnings? Are you still capped on the amount you're getting for the voyage? I mean, during the wait, are you then servicing the ships as well and helping them find the cargo so that adds to your rates as well?
Look, the race is still very strong. We have been fixing VLCCs out of the Arabian Gulf at between 200,
Mm.
$250,000 per day. Suezmaxes
Mhm.
in the Atlantic were being fixed at 100, $110,000 per day. Aframax are making 80, $90,000 per day. So we are still actually historically, if we exclude like the war periods, we are at record levels.
Mm.
So rates are still extremely strong, especially for the period we are in. Typically, during the summer months in July, rates come off. But
Mm.
in this case, actually, rates are up and they're strong. And
Yeah.
as things happen now with the hostilities, again, the rates are going up.
Mm.
So, we are going to see periods of volatility. It's not a straight line up
Yeah.
and stay up all the time. So, as you see seasonality in the markets, you will see the rates come off a bit and then they go back up.
Yeah.
So this is the stub period. Refineries prepare for the summer driving season in the prior 2 months, so they have taken the oil that they needed, and now it's more about the product and the product moving and being utilized. In the U.S. now, this is driving season, July and August,
Yeah.
and also in other places you have extreme heat, so you have cooling needs, etc. So point is energy demand is up at this point in time.
Mm.
But as far as oil movement is concerned, in Q3 is when things slow down.
Mm.
And then from the end of Q3, so from the end of the summer months, from September onwards, there is a pickup in the
Mm.
trade. So
Mhm.
we expect that from, say, mid-September onwards, rates should again inflect up. This is
Yeah.
the normal seasonality. But
Yeah.
then layer on top of that, what is happening in Hormuz, and we could see again rates going up to record levels.
Yeah, yeah. But one thing to sort of, I mean, expanding on that, how Heidmar is not just a Hormuz pay, it's definitely a turnaround and value story, with a clean vehicle now as well. What percent would you say on top of, rates, where rates were before the war, what percent increase on your earnings do you think the war is having? And it doesn't seem like actually much of it's materialized yet. Would you say it's like 5-10%? What would you say roughly?
Yeah, I would say it's no more than 10-15%. So,
Brilliant.
I mean, as I said, the rates were already quite strong.
Yeah.
You can't forget that besides the rates, the important thing is the volume as well, because
Mm.
we have added a number of ships to our fleet over the last 4 or 5 months. So
Mm.
it's not just that the rates are strong or have gone up with the war. Overall, average rates are probably up, as I said, 10-15%.
Mm.
But the volume is up as well because we have more number of ships that we are working. So and we still expect another 5, 6, maybe 7 vessels which are expected to deliver over the next 5 months before the end of the year. So that's another 10% increase in the fleet size.
Exactly. Yeah.
Which is significant on the commercial side. So I think you have to layer in one where the rates are, but more importantly also that there are more number of ships that are being added.
Volume. Yeah. Yeah, we had, well, very quickly moving from an additional five vessels and now an additional nine, which is really good. And if you put percent on that in terms of growth and actually how much that should just bump up the share price, but also your earnings, I think people should be valuing those things as well. And I appreciate you addressing the seasonality because I think Q1 was, big switch from a 5 million loss, which was all sort of IPO costs anyway, to 3 million profit. But actually revenue was down from Q4, but obviously margins are higher and it's different in a different seasonality. So I really help. Thanks for addressing that as well.